Welcome to Daksham's Deconstruct. I am Karuna from research team. Every week we take one idea that's moving markets and we break it down to what actually matters. This week, the case for gold and why we think now is the time to look at it differently. Central banks are buying gold at a pace not seen in decades. Over 1,000 tons every year for 3 consecutive years. A recent survey found that not a single central bank plans to reduce its gold holdings. More than a third of them plan to actively increase them. This is not a trade, this is a structural shift. And it starts with one question. Why are the world's most powerful financial institutions quietly moving away from the US dollar? Let's deep dive into its history first. In 1974, the US struck a deal with Saudi Arabia. Oil, the one thing that every country needed, would be priced exclusively in dollars. Every nation that needed oil now needed dollars. Not by choice, but by necessity. And it compounded. Oil exporting nations were now sitting on vast dollar surpluses, which they recycled back into US Treasury bonds. Dollar demand went up, US borrowing costs stayed low. American financial power deepened. This was the petro-dollar system, backed further by the sheer strength of US economy and the unmatched liquidity of its treasury markets. The dollar became world's unquestioned reserved currency. For 50 years, it was untouchable. But now, few things are changing this system. First, in 2022, the US seized Russian foreign exchange reserves held in Western institutions. Every central bank watching understood the same thing, that dollar reserves can be frozen, but gold cannot. Second, US national debt has crossed $39 trillion. The long-term fear is dollar devaluation through money printing. Third, the petrodollar system itself is being challenged from the ground up by the rise of electric vehicle. The entire architecture of the petrodollar rests on one assumption. The world will always need oil, but EV adoption is accelerating globally. The energy transition is quietly also a currency transition. Fourth, and this is a structural one, the US is now turning inwards. Since January 2025, the Trump administration has aggressively pursued an America First agenda, prioritizing domestic interests over global commitment and stepping back from its traditional role as a guarantor of the global economic order. For decades, the world trusted the US to be a stable, predictable anchor, but now that predictability is in question. So when the anchor becomes unpredictable, the world look for an alternative. Countries across Asia, Middle East, and Latin America are actively reducing dollar dependency. Gold, which is a neutral asset class, has no counterparty risk, is loyal to no government, fits exactly what they need. But is this theme of central banks buying gold temporary? We think it's a long way to go. The upcoming chart tell a structural story. Central bank didn't just increase gold buying, they doubled it after 2022. This isn't a reactionary demand. It's a clear shift in how nations are managing reserves. Month after month, the buying never stopped. Even in March 2026, when Turkey and Russia sold heavily, enough to push the net negative, 37 tons of gross purchases still came in, led by Poland. 2 countries sold, the rest of the world kept buying. That is the demand flaw we keep referring to. While few investors were selling in March 2026, China's central bank was quietly buying more. Monthly purchases had moderated through much of 2024 and early 2025. But the moment prices corrected and sentiment turned negative, China stepped in, deliberately, without hesitation. This chart brings the central banks buying gold into perspective. China, India being the largest buyer in the past few years, despite being the largest buyer of gold over the last 3 years, China still holds only 6% of its total reserves in gold. India, despite 120 tons, sits at just 15%. The biggest buyer in the world are still under-allocated as compared to its world peers. And the gap between the peers is what we call opportunity. But why look at gold now? Gold had a strong run. The crowd followed, ETF inflows surged. Everyone was talking about it. Then came the correction. Since March, gold has pulled back 18 to 20%, and the reason is worth understanding because it's the same story playing out in reverse. Operation Epic Fury, the US military action in West Asia, changed the calculations, but only temporarily. If the US controls the flow of oil from the region and the de-dollarization narrative weakens, oil goes back to being priced and settled in dollars. The petrodollar lives. The case for a neutral alternative becomes less urgent. And the oil did go up. Higher oil prices means more dollar demand. More dollar demand means stronger dollar. And a stronger dollar puts money away from gold. Investors book profits, momentum traders amplified the selling. The effect showed up immediately in flows. North American gold ETFs recorded their largest ever monthly outflow, $13 billion in a single month. Indian inflows too dropped from 24,000 crores in January to just 2,266 crores in March. But here is the critical question. Did this thesis actually break? No. The gold volatility index has since moderated. The sellers have sold. The momentum traders have exited. The conversation has just quietened. And the structural case, de-dollarization, central bank buying, US debt, has not changed one bit. This is what an entry point looks like before the next wave arrives. So, what's our view? Increase allocations. Over the next 3 years, we believe gold can outperform broader equity markets. But be clear-eyed. This is a directional bet and not a guaranteed return. Gold carries real volatility. For us, it remains a subcategory within alternatives, but one where allocation can reasonably be increased to 5 to 7% of the total portfolio. The foundation is solid. Central banks buying has created a demand floor that didn't exist 5 years ago. De-dollarization is a decade-long shift. It doesn't reverse in a quarter. The crowd has stepped back. The volatility has settled. The entry is less crowded than it was 3 months ago. Don't wait for everyone to start talking about it again. But we'll be honest about the risk too. The US remains an extraordinarily powerful economy. If it reasserts control over the global oil flows through West Asia, through Venezuelan supplies, the petrodollar gets a new lease of life. And this de-dollarization slows meaningfully. But the reallocation is real, and there is still steam left to it. But the story could still surprise you in either direction. So, size your risks well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.